Welcome to this video on the stock market. This is the course outline, covering everything from what a stock is to different types of analysis and ratios. A stock represents ownership or equity in a company, and a unit is called a share. Stocks are traded on exchanges like the NYSE and NASDAQ. The stock market is a venue where buyers and sellers meet to exchange these shares, facilitating efficient price discovery and dealing. The stock market performs several key functions. These include ensuring fair dealing in security transactions, efficient price discovery, and maintaining liquidity. It also supports all eligible market participants, provides investor protection, and ensures balanced regulation. Companies issue stocks to raise funds for various purposes, such as paying off debt, funding research and development, investing in growth, and launching new product lines. There are two main types of stocks: common stock, which grants ownership and voting rights, and preferred stock, which has no voting rights but offers more stable dividends and is prioritized during bankruptcy. Stocks can be categorized by their sectors, including energy, materials, industrials, consumer discretionary, consumer staples, healthcare, information technology, telecommunication, financials, utilities, and real estate. Stocks are also categorized based on market capitalization. These include mega caps with a market cap over $300 billion, large caps between $10 billion and $300 billion, mid caps between $2 billion and $10 billion, and small caps between $300 million and $2 billion. Micro caps have a market cap between $50 million and $300 million. Nano caps have a market cap of less than $50 million. Remember, market capitalization equals shares outstanding multiplied by share price. Let's look at two examples of how market capitalization is calculated using shares outstanding and share price. Companies are measured by their market cap, which changes over time as share prices and shares outstanding can fluctuate. You should invest in stocks to beat inflation, grow your wealth, and earn a second income. Investing can be cheap, and you don't need to be a genius to start. To profit from a stock, you can buy low and sell high, or buy high and sell even higher. You can calculate your returns in several ways: dollar return, percentage return, and the R multiple. Key terminologies in trading stocks include long/short, bid/ask, and spread. There are also different types of orders: market order, limit order, stop order, and stop loss. The types of stocks or equities you can invest in include individual stocks, mutual funds, index funds, exchange-traded funds, ETFs, and real estate investment trusts, REITs. To analyze and evaluate a stock, you primarily use two methods. Fundamental analysis involves looking at valuation, profitability, liquidity, debt, and efficiency ratios. Technical analysis focuses on chart patterns, price actions, candlestick patterns, trends, and support and resistance. Fundamental analysis begins with the valuation ratio, specifically the price to earnings or PE ratio. This ratio shows the relationship between the price per share and the earnings. A high PE ratio may indicate a stock is overvalued or that high growth is expected. The PE ratio is calculated by dividing earnings per share by market value per share. The PE ratio is a good starting point for valuing nearly all companies and comparing them quickly. Its advantages are that it is widely used and easy to apply. However, its disadvantages include being easily manipulated and not incorporating the balance sheet. Next is the price to sales, or PS ratio. This is an investment valuation ratio showing a company's market capitalization divided by its sales for the previous 12 months. A ratio of less than 1 is favorable, while anything over 4 is generally considered unfavorable. The PS ratio is useful for companies without earnings, such as fledgling companies or cyclical companies like airlines, which may go through unprofitable periods. It's a stable metric and less susceptible to accounting issues, but it doesn't take profitability into account. We move on to price to book, or PB. This is the ratio of price to book value per share. Book value is the value of an asset according to its balance sheet. The formula is market capitalization divided by book value or share price divided by book value per share. The PB ratio is best for banks and can be used during periods of negative earnings, since book value tends to be less volatile than earnings. It is a stable metric, but accounting differences can make comparisons difficult. Focusing on profitability ratios, we look at profit margin. Different profit margins, like gross, operating, pre-tax, and net profit margin, measure a company's profitability at various cost levels, with margins shrinking as more costs are considered. The return on asset, or ROA, measures how efficiently a company generates profit from its assets. A higher asset base can lead to more sales and potential profits. The formula for ROA is net income divided by total asset. Next is the return on equity, or ROE. This is a key ratio for shareholders, as it measures a company's ability to earn a return on its equity investments. The formula for ROE is net income divided by shareholders' equity. Moving to liquidity ratios, the current ratio measures a company's ability to pay off current liabilities with current assets. A higher ratio indicates better liquidity. The formula is current assets divided by current liabilities. The quick ratio measures a company's ability to meet short-term obligations using its most liquid assets, excluding inventories and prepaid expenses. It's also known as the acid test ratio. The formula is current assets minus inventory and prepaid expenses, all divided by current liabilities. For debt or solvency ratios, we consider the debt-to-equity, DE ratio. This ratio compares total liabilities to shareholder equity to evaluate company leverage. Higher ratios suggest higher risk to shareholders. The formula is total liabilities divided by total shareholders' equity. When investing, you gain from either appreciation or dividends. Appreciation is a rise in share price, leading to a capital gain when sold, but is not guaranteed. Dividends are recurring income, usually quarterly, paid from company profit. Value investors use fundamental analysis to find undervalued companies and hold them long-term. Momentum or growth investors focus on future potential, often in emerging, riskier industries, and metrics like PE and PB don't matter as much to them. This concludes our overview of fundamental analysis ratios and investing strategies. We hope this video has provided valuable insight into how to evaluate stocks.